$42. That is the gap between where Penumbra Incorporated is trading right now and where Boston Scientific has agreed to buy it. $332 on the market, $374 per share is the deal price, a 12.5% spread. That is either a gift or a warning, depending on what you think the FTC is about to do.
And that is the central tension of this episode. Penumbra reported first quarter 2026 earnings this week. Revenue of $375 million, beating estimates by $7 million. Adjusted EPS of $1.18 against expectations of $1.09, the eighth straight quarter the company has beaten Wall Street's numbers.
So you have a company firing on all cylinders. 17% revenue growth, net cash on the balance sheet, 8 consecutive earnings beats, sitting at a 12.5% discount to a signed acquisition agreement. That spread is what we are here to unpack today.
Let me set the stage on the business first. Who Penumbra is, what they make, and why a deal of this size happened in the first place.
Penumbra was started in Alameda, California in 2004 with a specific mission: build minimally invasive devices for some of the most difficult medical interventions in existence, treating strokes and vascular occlusions in the brain and body. Today, the company operates in 2 primary segments: neurovascular and peripheral vascular.
The neurovascular business is the heart of the company. Devices for mechanical thrombectomy, which is how doctors physically remove blood clots from arteries in the brain during an acute ischemic stroke. Penumbra's systems go into the catheterization labs of hospitals around the world, used by interventional neurologists and neurosurgeons in some of the most time-sensitive procedures in medicine.
The peripheral vascular segment covers similar catheter-based intervention, but in the arteries and veins of the body outside the brain, including arterial access systems, venous thrombectomy, and specialized catheters for complex vascular procedures. This segment has been growing faster than neurovascular, at roughly 22% year-over-year in Q1 2026.
The business model is relatively straightforward. Penumbra sells its devices to hospitals on a per-procedure basis. Individual device purchases rather than long-term contracts. The recurring revenue element comes from clinical workflow. Once a hospital's neurovascular team gets comfortable with Penumbra's catheter handling characteristics, switching to a different device family is operationally disruptive.
That switching cost dynamic is the core of the moat here. In mechanical thrombectomy specifically, physicians develop procedural muscle memory, the way a catheter navigates, torques, and responds to their hands. Penumbra has accumulated clinical evidence supporting its systems, which creates another layer of inertia beyond just habit.
And it explains why Boston Scientific was willing to pay 9 times trailing revenue for this company. You are not just buying a product line. You are buying a clinical franchise, a physician relationship base, and a 17% growth engine in a market that is structurally expanding as stroke treatment technology improves and awareness of mechanical thrombectomy grows globally.
The company operates in more than 100 countries, with roughly 65 to 70% of revenue from the United States and 30 to 35% internationally. Let's talk about the person who built all of this.
Adam Elsesser co-founded Penumbra in 2004 and has been the company's president and chief executive officer since day one. He took the company public in 2015 and has led it through more than 2 decades of continuous growth, from a startup to a multi-billion-dollar medical device leader. That is a genuinely rare arc.
The street's view of Elsesser is largely positive. He has maintained a disciplined focus on organic product development rather than acquisition-driven growth, a strategy that preserved the company's innovation culture and built the proprietary device portfolio that ultimately attracted Boston Scientific. His track record of 8 straight earnings beats speaks for itself.
The operating performance has been unambiguous. 8 straight earnings beats, consistent 17% revenue growth, and a balance sheet with more cash than debt. Let's look at the numbers in detail. Let's talk about what Penumbra's finances actually look like.
I'll start with valuation, since in this case the valuation is partially a function of the deal. At $332, Penumbra trades at 73 times trailing earnings and 69 times forward earnings, very high multiples, but they are anchored to the deal price rather than an open market valuation. Standalone, this stock might trade at 40 to 50 times earnings for a high-quality medical device grower at this stage.
So the optically expensive multiple partly reflects the deal premium embedded in the current price. On a price-to-sales basis, the stock trades at 9 times trailing revenue, a premium multiple appropriate for a company growing at 17% with nearly 68% gross margins. EV to EBITDA sits at 62 times, again elevated by the deal premium dynamics.
Let's talk revenue. Q1 2026 revenue of $375 million represented 17.6% growth year over year, a slight moderation from Q4 2025's $385 million, which was the highest quarter in company history. The trailing 12 months stands at approximately $1.45 billion. The street had expected $368 million. Penumbra beat by $7 million.
17% growth on a billion-dollar revenue base is genuinely impressive for a medical device company. Within Q1, neurovascular grew approximately 14% year over year, and peripheral vascular grew approximately 22%, confirming that the newer, faster-growing segment is accelerating its contribution to the overall mix.
What does the margin picture look like?
Gross margin on a trailing 12-month basis is approximately 67.5%, strong for a device company, reflecting the premium nature of neurovascular catheter systems. Operating margin for Q1 was approximately 13.5%, lower than the gross margin would suggest because Penumbra continues to invest heavily in R&D at roughly 15 to 16% of revenue. Net margin for the quarter was approximately 11.5%.
The R&D intensity is a deliberate management choice, right? Penumbra is not trying to maximize near-term margins. It is building the next generation of devices.
Exactly right. Penumbra's management has consistently prioritized innovation spend over margin expansion, and the payoff has been the clinical differentiation that justifies both the growth rate and the acquisition premium. On cash flow, operating cash flow on a trailing 12-month basis is approximately $185 million. Free cash flow is approximately $150 million.
Q1 is typically a lighter quarter for cash generation. What is the balance sheet situation?
The balance sheet is a notable strength here. Penumbra carries approximately $545 million in cash against $217 million in total debt, a net cash position of $328 million. Current ratio of 6.64, quick ratio around 5.2. This is a fortress balance sheet for a company of this size. Total equity is approximately $1.25 billion.
So no leverage risk, no dilution risk, no dividend pressure, just a clean balance sheet sitting with more cash than debt. And the company pays no dividend, meaning all cash generation is available for reinvestment or to support the deal mechanics.
Precisely. Adjusted EPS for Q1 came in at $1.18, beating the estimate of $1.09 by 9 cents. That is the 8th consecutive quarter Penumbra has beaten the earnings estimate. Not by a small amount this time either, at 8% above the estimate. Overall, Penumbra's financial health is strong. The company has fortress balance sheet liquidity, 17% organic growth, and consistent earnings delivery, with the only complexity being deal-driven multiple expansion rather than fundamental stress.
What does the street think about Penn right now? I will note up front that this is a somewhat unusual situation. Most analyst coverage effectively reflects a view on the deal rather than the standalone business.
That is exactly the dynamic. Following the Boston Scientific acquisition announcement, most analysts who had buy or overweight ratings on Penn moved to neutral or hold. Not because the business deteriorated, but because the deal price effectively caps the upside. You have 14 hold ratings, 4 buys, and 0 sells across 18 analysts covering the stock.
The price target picture tells the same story. The analyst community's median target sits at around $362, which is essentially saying deal close at $374 with a modest probability haircut. The high target is $374, which is the deal price itself. The low is $266, which represents the deal break scenario.
Goldman Sachs, JP Morgan, Piper Sandler, and William Blair all moved to neutral or equivalent immediately following the deal announcement in late 2025. Needham and Canaccord have maintained buy ratings through Q1 2026 results, citing the ARB opportunity and the underlying business quality as justifying a constructive stance even in a deal-pending environment.
The Q1 earnings reaction was muted relative to the size of the beat. A 9-cent EPS beat and a $7 million revenue beat in a normal quarter would have moved the stock 2 to 3%. In a deal-pending situation, the stock is essentially pinned to the spread math. It moved only modestly because the deal price is the binding constraint on near-term upside.
That is the paradox of investing in an acquisition target. The better the earnings, the stronger the argument that the deal will close, but you cannot get above the deal price while the deal is pending. Let's talk about the two sides of this trade.
On the bull side, the core case is elegant and simple. The deal closes, you collect $374 per share, and you have earned 12.5% in a period of months on a deal with strong business fundamentals underneath it.
How long is the expected timeline?
Management has guided toward a close in the second half of 2026, pending regulatory approval. The FTC review process for medtech deals typically takes 4 to 8 months from filing. Even if the deal closes in Q4 2026, that 12.5% return in roughly 9 months is an annualized 30% on capital, the math that makes merger arbitrage attractive.
The second bull argument is that the underlying business justifies something close to the current price even without the deal. Penumbra is growing at 17%, has nearly 68% gross margins, and has demonstrated consistent execution. High-quality medtech growers at this scale trade between 35 and 50 times earnings on a standalone basis. At 40 times trailing 12 months EPS, you get a standalone valuation in the $170 to $180 range, meaningful even if well below the current price.
So the spread between current price and standalone valuation is roughly $150. That is the deal premium the market is pricing in, and it disappears immediately if the deal is blocked. That is the risk.
The third bull argument is the balance sheet. $328 million in net cash provides a meaningful floor on downside even in a deal break scenario, because Penumbra can use that capital for buybacks or strategic investments to support the stock if the acquisition does not proceed.
All right, let's flip sides. Make the bear case.
The primary bear case is FTC block. The current regulatory environment for large healthcare deals has been unpredictable. If the FTC issues a second request or moves to challenge the combination of Boston Scientific and Penumbra on competitive overlap grounds in neurovascular or vascular intervention categories, the deal becomes uncertain, and the market would price Penn back toward $250 to $270 almost immediately. That would be a 20 to 25% decline from current levels.
That is a significant potential drawdown for what on the surface looks like a straightforward medtech deal.
The second bear argument is standalone valuation risk. If the deal breaks and Penumbra needs to reestablish itself as an independent investment thesis, the stock would need to trade back to fundamentals, and at 73 times trailing earnings, the valuation is demanding even for a high-quality grower. In a deal break scenario, the combination of a lower fundamental multiple and investor disappointment could weigh on the stock well below pre-announcement levels for an extended period. The third risk is timeline. Even a successful deal outcome that takes 12 or more months to close creates meaningful opportunity cost on capital sitting in this spread.
Let's see how Penumbra stacks up against its closest publicly traded peers on valuation. I'll frame this around price to sales since earnings multiples are somewhat distorted by the deal dynamics.
At 9 times trailing revenue, Penumbra sits between Intuitive Surgical at 15 times and Boston Scientific, the acquirer, at 5.5 times. That relative positioning actually tells the story of the deal. BSX is paying 9 times revenue for Penn, a significant premium to its own valuation, because Penn's neurovascular franchise carries premium margins and a strategic position in stroke treatment that BSX values highly.
Intuitive Surgical at 15 times sales represents the aspirational ceiling for surgical device companies. ISRG commands that premium because its Da Vinci installed base generates recurring procedure revenue and a deep software moat. Penumbra is not quite at that level of recurring revenue intensity, which is why 9 times is a reasonable premium rather than 15 times.
And then there is Integra LifeSciences, another neurosurgical device company, at roughly half a time's sales after a series of operational challenges. That comparison illustrates what can happen to a medical device company that loses execution discipline, and why Penumbra's clean track record has been so valuable in justifying the acquisition premium.
The peer group makes clear that Penumbra's deal price is aggressive but not absurd given the growth profile. Let's move to the options market.
The options market on Penn tells a clear merger arbitrage story. Implied volatility is sitting at the 42nd percentile of Penn's historical range. That is moderately elevated by medical device standards, driven by deal uncertainty rather than any fundamental earnings risk.
Call open interest is heavily concentrated at the $374 strike, the deal price. Merger arb funds buy calls at the acquisition price to create asymmetric exposure to deal close. Put activity has clustered at $300 and $320 as downside hedges against a regulatory block scenario. The put-to-call ratio of about 0.8 reflects a modestly bullish lean. The options market is pricing deal close as the base case, but is not ignoring the regulatory tail risk.
The IV at the 42nd percentile is actually somewhat reassuring. The options market does not view a deal block as highly probable, or we would see implied volatility much higher. Let's move to insider activity.
Insider activity at Penumbra, since the acquisition announcement, has been effectively zero in both directions. Under the merger agreement's standstill provisions, insiders are restricted from open market buying or selling outside of pre-approved trading plans. The result is zero open market purchases and zero discretionary insider sales in the period since the announcement.
This is not a signal, it is a contractual silence. Standard merger lockup mechanics. It tells us nothing meaningful about management's view of deal completion probability. Let's talk about the key risks and watch points.
The top risk is FTC regulatory action. The Federal Trade Commission has shown increased willingness to scrutinize large healthcare transactions, and the combination of Boston Scientific and Penumbra in adjacent cardiovascular and neurovascular categories could attract scrutiny. A second request from the FTC would extend the timeline meaningfully and introduce a higher probability of a litigated path to deal close.
The second watch point is deal timeline extension. Even if the regulatory outcome is ultimately positive, an extended review into late 2026 or 2027 creates significant opportunity cost for capital sitting in this spread. Watch for any regulatory filings, FTC correspondence, or Boston Scientific commentary on deal timeline in their own earnings calls.
And for the standalone business, watch quarterly revenue growth. If Penumbra's organic growth decelerates below 15% for any reason during the review period, it weakens the standalone investment thesis and reduces the deal strategic rationale for BSX simultaneously. The business has to keep executing. Let's pull it all together.
Here is the bottom line on Penumbra. This is a high-quality medical device company in the midst of a pending all-cash acquisition by Boston Scientific at $374 per share. The stock at $332 is pricing 12.5% regulatory risk. The business is executing at a high level, 17% revenue growth, 8 consecutive earnings beats, $328 million in net cash. The deal is the thesis.
The key metric to watch is the merger spread. If the spread tightens toward 5%, the market is signaling high confidence in regulatory approval. If the spread widens toward 20% or beyond, that is the market pricing a meaningful probability of deal block. Secondary to the spread, watch quarterly revenue growth. Any deceleration below 15% weakens the standalone fallback thesis and the deal strategic rationale simultaneously.
This is a story about a company that built something valuable enough that a strategic buyer paid 9 times revenue for it. And now the question is whether regulators will let that deal close. That is not a question about the business. That is a question about Washington.
Warren Buffett once said, "Price is what you pay, value is what you get."
At $332, you are paying for a piece of the merger spread. At $374, Boston Scientific believes it is getting the value of a neurovascular franchise that will compound for decades. Those two numbers are the whole story in one sentence.
That is going to do it for this episode of Charged Alpha, Penumbra Incorporated, ticker PEN, Q1 2026. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
If this episode gave you a different angle on merger arbitrage or medtech investing, leave us a review. It helps more listeners find the show. Until then, I'm Lana Chen. This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.